and that Ralph is on the other side of the line, and that is absolutely true. I think Richard's too young to be that negative. Richard, where are you? There you are. The title is Secular Bull Market, Global Secular Bull Market. I'm going to underscore the word global this time around. Some people might have heard parts of this presentation over the last couple of years. In fact, I'd say in the last 4 years, maybe 4.5 years, I've been touting the word secular for a long, long time. Now, let's define the word secular. A secular advance or a bull market means something that could last a decade or more. And if you believe that we're in a secular bull market, which I do, we're 5 years into this bull market. So by definition, I humbly stand in front of you and say we have at least 5, maybe 10 or 15 years left. Interesting. I also believe that the low that we all witnessed in March of 2009 was a generational low. And I know there are some commentators out there calling for a major, major crash well below the March 2009 lows. And honestly, I just have no idea what they're talking about. Yes, the market is extended. Yes, the market needs to correct. We can go on. And yes, there are problems, a litany of problems out there. But to say that we're going to reverse all of it, all of the gains we made in the last 5 years, I cannot see that. I do not see that. I can't justify it, whether I do it economically, fundamentally, or technically. I can't do it. I'm going to share with you a picture. This photograph was sent to me 2 weeks ago. It was taken in 1970. The ugly guy on the right-hand side is myself. I'm 29 years old. It is 1970. The young man in the middle is about 24, I say 25, 26 years old. He's a couple of years younger than me. His name is Johnny Brooks. John Brooks and I, together, started the Market Technicians Association. We were looking to gather like-minded people to talk about markets, not just on a fundamental basis, but on a technical basis. That organization today has many thousands of members, and they're located in chapters in 85 countries around the world. I am very proud of that fact. And that photograph, by the way, unfortunately, John passed away about 5 years ago, and his wife, Joanne, sent me a basket of pictures she found, and that was buried in this pile of pictures, and for which I am totally grateful, because this photograph, I've talked about this evening over and over again in my presentations. This was the first evening dinner meeting that this little organization had. The organization is about 3 or 4 months old, and we've gathered the founding fathers together. Okay? This gentleman on the extreme left, his name is Ken Ward. You never heard of him. At the time, Ken is 85 years old. In 1970, he's 85 years old. That meant he lived through every bull and bear market in the 20th century and wrote about it. He was a writer. He was an analyst. In those days, we called them statisticians. They didn't call us analysts. Okay. Me sitting next to Mr. Ward is like me sitting next to my favorite baseball player, Mickey Mantle. if you know Mickey Mantle. And I, at one point, got the energy and the courage to ask Mr. Ward. I said, Mr. Ward, what was the most difficult market you ever had to live through or write about in your career? And then I stopped and said, oh, Mr. Ward, I'm sorry to ask such a silly question. It has to be the crash of 1929. And with a grovelly voice, that little old man leaned over, he pushed Johnny out of the way, he says, no, young man. 1929 was not the toughest market for me. I was shocked. And he said, the most difficult market was the early 60s, 1960s. I said, but Mr. Ward, it went up. He said, yes. In the face of all the bad news, it kept climbing and climbing and climbing. He said, analysts like himself We were looking for corrections, always looking for a pause. The market was over. Does it sound familiar, ladies and gentlemen? Do you know what that period of time has with the same period we're in now? The relationship? There's a common denominator. It's called low inflation, low interest rates. That's the fertile ground upon which secular bull markets live. And one of the arguments that the bears make is that they're worried about quantitative easing ending in the United States. Everybody's worried about that, trust me. They're worried about, oh my gosh, the end quantitative easing rate's going to go up. Well, rates are like cholesterol. You have good cholesterol and you have bad cholesterol. If rates go up because of inflation, that's bad cholesterol. If rates go up because of an improving economy, that's good cholesterol. But either way, rates are going to go up someday. I don't think they're going to go up anytime soon. But everybody's saying 2015 is probably the year it's going to go up. You remember tapering a couple of years ago? Everybody was so worried about tapering, and when it happened, we had a correction. Didn't last very long. No one's worried about tapering anymore. So I think that's how the market's going to react to rising rates whenever it happens. We'll have a correction. But that'll be it. I do not see a problem with rising rates. In fact, if you go back historically, I'm sorry I don't have a picture of this, if you go back in time and you see that there are periods of time when the stock market goes up with rising rates. And I think if you get rates above, let's say, 5.5%, 6%, then I think it becomes problematic for equities. But I don't see that anytime soon. This picture you got here is probably what concerns most people like myself. This year in the United States is the it's a midterm election year. And historically, sometime after the first quarter, second or third quarter, look at that, historically, in the years, we have some kind of a correction or bear market. And I have to be totally honest with you. I was a little concerned in April. I thought the market was going to have one of those corrections. I was right for about a week. The S&P dropped 3.2%. They went to a new high. I'm going, wow. And then I tried it in July. Remember the Russians going into Crimea? We got a 4.7% correction. And the market goes to a new high. Now we're right here. Look at the middle, towards the right. You see the September, October period? Oh, I got a pointer. What is it? The pointer is here. No? How does this pointer work? No, I guess it's not a pointer. All right, anyway, so you see down there on the right-hand side, right over here. This is September, October. Historically, in the United States, it's a terrible time of the year. Volatility. The last I looked, a day ago, market doesn't look like it wants to get down much. But even if it has a correction, I want, for my presentation, I want to look past any kind of correction we might have in the next 2 months. I look past that. Now I'm in the fourth quarter of this year. This midterm election, historically, the fourth quarter is very, very strong. So I humbly stand in front of you and say, all right, you want to have a correction? Go ahead. For me, it's a buying opportunity. Because I think between now and the end of the year, the S&P could be up another, I think the S&P could be 2,100. That's another 5%. It's up 4% now, 10%. Let's say it's up 10%, 9-10% of the year after being up 30% last year. It's not bad. This is in the face, by the way. You pick the geopolitical problem that you want to think is going to really, really cause us a lot of problems. Pick one. I think this thing with Putin is just insane. By the way, I read a book. I love to read military history books. And about 2 years ago, I read the book, The Crimean War. The Crimean War was in 1857. Tsar Nicholas in 1857 went into Crimea. Why? To protect the Russian Christians. Putin's doing the same thing, protecting some of the local Russians. It's insane. He's writing the book all over again. And we had a 4.7% growth rate. Trust me, when that was happening, I went into the fetal position. I was under the table crying mama. I think, well, this is the correction. Market's overextended. Everybody's talking about the need for a pause. We got the catalyst. I only use one word to describe this, folks. And the word is amazing. I am totally amazed. These last 5 years, remember in 2010? We had the pigs. Oh, I thought for sure the bull market was going to take out the 2009 low. The bull market had to die on that. I think we were down 13%. Again, please forgive me, I don't want to make light of the problems out there. I'm just saying the market is looking beyond these problems and it's saying, gee, there must be something better out there. I think there's a slow growth comeback. But my message to you today, I'm just talking about the U.S. now. Forget the U.S. I think the growth is a game of catch-up around the world. And then finally, other markets. Richard, you said something this morning, and my ears went up. When you said that this is the best conference you've had in years. You had, no, seriously, you had 500 plus people here. Am I correct?
Yeah.
That's a sign of confidence, Richard. You didn't do that last year or the year before that. Because people around here or around the world actually were really a little tentative about investing. People are now spending their entire day sitting down trying to get ideas about investing. Why? Because they feel a little more confident. And they read the same newspapers and watch the same TV shows that I watch. And they're scary with the headlines. And yet they're here talking about and listening about investing. I'll give you, Richard, you only gave me 20 minutes. I wouldn't have gotten a lot more granular in my presentation. But I got to give you an idea about it. In the States, if you're looking at investing. By the way, are you aware of this? S&P 500, 500 stocks, correct? You know what the average price of those 500 stocks are today? $100. I'll repeat. The average stock in the S&P 500 sells for $100. You know how many stock splits there were in the United States this year? 6. If it were up to me, I'd split them 2 for 1. I'd split them 10 for 1. I'd love to see those stocks down to high double digits. Low double digits. I'd love to see them $20, $30. The public will come back then. The public is not in the market, says, I want to pay $100 for a stock. They're waiting for the correction. Where is the public these days? I went to my travel agent the other day to get tickets to come here, and I was standing by the doorway, and they had this rack of all these pamphlets about trips, cruises around the world, cruise around the Rhine, and cruise around England and places like that. I was on the cruise in the Mediterranean. Beautiful. And I asked them, I said, how's the cruise business? This lady get up. She says, I'm in the business 20 years. I've never seen it so good. I got to tell you, I bought a Jeep, one of these little Jeeps, and I asked the guy, how's business? I had to wait 5 minutes because he had a line of people, or 10 minutes, for him to talk to me, to sell me a new car. Remember Peter Lynch? Look around, see the parking lot, talk to people, how are things going? Trust me, they feel better. The first 4 years, I'd say the first 3 years, 9, 10, 11, 12, there was disbelief. It was hard to get people to invest. It turned last year. We started to see people a little bit more interested, not just in the States, but around the world. And it was manifest in the fact that small and mid-cap stocks, the Russell 2000, started to do very well the second half of last year. And I'm going to show you a couple of pictures now, charts. Here, look at this. I'm sorry, can you see me back here? This is the Mideast. It's an ETF. MES is the symbol, okay? Here's your March '09 low. It peaked in 2010 and went sideways. This line here is the MES, the Mideast, versus the S&P 500. It underperformed all these years. Look at what started happening. The relative performance of the MES has started to pick up. But more important than that, look at the price action of the MES. It started to pick up early in 2013. Ladies and gentlemen, from a technical point of view, this is a massive, massive bottom. The implications, if you are secularly looking out 5, 10 years, my heavens, things have changed. I'm very impressed. You're not impressed? Cheering? Happy? Good news. Richard. Look at this one. Oh, by the way, I think I have notes on that last one. Let me get some numbers for you. Yeah, I got some numbers for you. The MES. Yes. Listen to this. The MES, since January 2013, okay? Year to date, the MES from January 2013 is up 73.1%. And the S&P is up 38%. That's why the relative is outperforming. That to me is good stuff. Oh, BRICS. We all know the BRICS. Brazil, Russia. We won't talk about Russia. Whatever the story on that. But India and China. By the way, this picture is a couple of weeks old. We had to send it early. This trend here is broken. It's testing its 2011 high. I get my numbers here. Right. It peaked in April 2011. It's down 19.1% since its high. And the S&P is up 47%. No wonder the relative strength line has collapsed. But I think it's starting to turn. It's early, starting to turn. When I go get a little granular and I start to look at the components in there, I see Brazil is close to making new highs. I see Brazil infrastructure, Brazil consumer, Brazil financials is up 35% this year. Brazil financials. Brazil consumers is improving. It's up 23% this year. No one's talking about Brazil. I don't hear much about it. China. China is 7.2% away from its May 2011 high. It's almost ready to break out. If it breaks out, every person in the world with a chart is going to get very excited about China. But when I look at China technology, the symbol is CQQQ. I think it's about $35 US. It looks very, very attractive. You know what the most attractive is China's small cap. And lastly, India, what can I say? It's making new highs almost every day. So, drop the R, and you got big. B-I-C. I thought you'd laugh on that. Okay. Here's Europe. I heard someone talking this morning concerned about Europe, but look at it on a relative basis. Look at this. Versus the U.S., it's a disaster. But when I take the engine of Europe is the DAX. You know the DAX from its March 2009 low, it's up 180%, and the U.S. S&P 500 is up only 173%. Hello? DAX like this. With Putin knocking on the door a few miles away. I think France looks exactly like that picture. France is about to get back to its high. It's 70% off its okay. Now I think it's about 15%, 20% off the high. I think I have one more for you. Pacific ex Japan. Pacific ex Japan. By the way, this picture is dated also. That is a new. Not a new, it's not above this high, but it's above this high. And the relative is still underperforming. But when I do a little granular work and I look at Malaysia, Indonesia, Australia, the Philippines, they're making new highs, most of these countries. So my message to you is, yes, the secular bull market is alive and well. Of course we're going to have a correction someday. I think it's minor, especially when I showed you the fourth quarter. I think you buy any kind of a dip here. Even in the face of all this geopolitical problems, unless something absolutely terrible happens overnight, which could. But this time, don't be so focused. Be global. The secular bull market is catching on. When I heard that this was the best conference in years, that's music to my ears. Gold. I have to tell you something about gold, but again, the word amazing comes to my mind. Here's what gold did in 07, everybody knows that. Then it had a 2-year decline. It's been sitting here. Gold here since the latter part of 2013, all of 2014, trading between 1189 and 1400. Okay? So you want to say, what's happening in gold? I'm going to mumble that. Gold's neutral. Oh, I think you can trade it or something. Do I see anything really powerful on the upside? A couple of months ago, there was a very powerful rally. And in fact, I emailed all my partners. I said, gee, gold looks like it's picking up. With all of these geopolitical problems we have, folks, gold is still sitting there. I'm amazed. You would think it'd be 1,500. Why? I'll tell you one thing, for the record, if you own gold, fine. Want to add to it, fine. But if it ever takes out those recent lows, 1189, please sell. Brent crude. Look at this. You don't have to be a technical analyst to see this. By the way, whenever you read a chart, your eye is always in the most current price, and your hand goes this way because you're going back in time. Look at the last 3 years. Crude is trading roughly between, let's say, 95 and 120 or 125. And I'll mumble again. I do not want to see Brent crude below 95. But I'll give you the benefit of the doubt that it's in the trading range. Crude in the States looks a little weaker. You don't want to see that much lower, then that presents a problem. So yes, I have neutral pictures that I can live with. And I have some strong pictures that are just about. How am I doing for time for that? 5 more minutes?
Really 5.
What?
Really 5.
Really 5. Do you like this chart? This is their 30-second commercial. By a little firm called Acampora and a firm called Shape & Home in New York, combined together. And this fund is Ethical Global Fund. It's going to be 3 years old next month. It's up 50%. High div. Low PEs, high div. That's the whole philosophy. And versus this fund versus the S&P Global Sharia Fund has, I don't know how many hundreds of names in there. This only has 30 stocks. 65% of these quality companies, 65% in the U.S., and the other 35% are international. I think this is where we should be going, at least part of you should be going, to something like this. And since I only have a couple minutes, and I want to save 1 or 2 minutes for questions, if there are any, I've always been asked, hey Ralph, what does your secular bull really look like? Now, I'm going to show you a picture of my secular bull. It is not a graph. You ready? Isn't he beautiful? This is really cool. It's a cooler. You put ice in it, put your soda in there, pull them by the ring, put them in your oven. So I thought I'd put a smile on your face before lunch. This is my secular bull. I think he's here to go another 15 years. I have a couple of minutes, I think. Either that or I'm going to get the hook. Richard, why don't we put some gloves on? You and I go at it. The bull and the bear.
Well, since I'm so young, Ralph.
not younger than me, big guy.
Well, that's true. I'm in my 30s now. You must be in your early 50s.
73, so.
73 is fine age. Has anyone got any questions or comments or anything they'd like to make before we break lunch?
Please, somebody, a question. I was trying to jazz it up a little bit here for you. No questions? You're all bullish? Yes? Yeah.
Hi there.
Hi there.
My name is Vinod, and I'm into equities and other asset classes as well. The slides that we have seen here are mostly equity related.
Yes.
So, had to ask a question on, do you have any charts or analysis on VIX index and also on the tanker rates? Because we have been speaking about recoveries and stuff like that.
The tanker rates I don't have, but I have a mental picture of VIX for sure. You know the VIX is a volatility index, correct? Whenever it rises, people are getting nervous. Whenever it sits there.
How does it look like now and what's your
okay.
take?
Whenever it's low reading, 19, 20, 21, 22, that usually is a sign of complacency. People get very nervous when people are not nervous. When people are not nervous, people, the researchers get nervous. That's how it works, okay? But when you're in a secular bull, which we have been, guess what? That stays down there. And then when you get some volatility, you don't get the spike as big as it was in 2007 and 8. I think the VIX went up to 189. No. If it gets up to 25, you're probably near a near-term bottom. 40 for me would be a major bottom. And right now, people say, well, it doesn't work anymore. It works. What it's telling you is that this is a bull market. The fact that it can stay low. One of my old mentors, in fact, that old gentleman, one of his friends, same age, said to me, when a technical analyst calls the market oversold, okay, it's oversold. That's like the VIX being very low. He said, think of a beach ball underwater, okay? That's the market. It's very depressed. What happens when you let your hand go? It pops. That's the nature of gravity and the beach ball. Okay. He said, imagine keeping your hand down. By the way, when you let your hand go, that's the market having a technical recovery, a technical rally. He said, Ralph, when you keep your hand down there, guess what? When you let the hand go, and you got the ball down there, and it doesn't pop, it goes lower. He says, guess what? That market's weaker than you think. Now just take that in the opposite and say, here's a market that should come down. It doesn't come down. Why?
And the VIX stays low.
Stronger than you think.
And the VIX stays low.
And it stays low. So, I look at it. I don't worry about it. Not now. It'll pick up.
And your take on the tanker rates and the correlation with recoveries and economic growth? The tanker rates, the international tanker rates.
No, I don't have an opinion on that.
Baltic Dry.
What's that?
Baltic Dry.
Baltic Dry. Yeah.
You know about that?
I don't have a picture in my mind.
No, that's right.
Yeah.
All right, thank you.
Tanker rates. Well, there's a stock that I follow called DRYS, Dries Shipping. That's the symbol DRY. I like to trade it for my own account, play with the money. Whenever it gets down to $2, $3, I buy. Because all of a sudden, if you're patient, it gets up to 6, 7. It's in the trading range. It's about $3 now. So and it's starting to pick up a little bit. So I think there's some international interest in shipping.